Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. And girls, it's another quiet, range-bound morning so far. It's Tuesday and the Nifty is up 56 points, 17,900 exactly at 11 a.m. The Sensex has gained 200 points. The good part is the Nifty is at least holding above the 20-day moving average, which stands at 17,838. The Asian markets are mixed. Hang Seng has a bit of a cut going for itself. That's down nearly 1%. And the Dow futures is suggesting a negative start. Remember, US markets were shut yesterday, but right now the Dow futures is down more than 100 points. The mid-caps also are holding up in the green, a gain of close to about a third of a percentage point, and the advanced decline ratio is marginally in favor of the gaining side. We've got about 1,500 stocks in the green for about 1,200 stocks in the red. This week is low in terms of cues, but if you have to pick up things that could move the markets, one, globally, the Fed minutes tomorrow, and for our own markets, the expiry on Thursday. One of the individual stocks that I'm watching today is Wipro, and Wipro is among the top 5 Nifty losers. So Wipro is currently down more than 0.5%. You know what reports are saying, and this is across, the company has lowered the fresher salary. So earlier, some of the freshers were promised 6.5 lakhs per annum, and now they're saying onboard us, join us at 3.5 lakhs. We're looking at a substantial near 50% cut, and this is just perhaps an indication of the slowing environment and the fact that attrition has been coming down for the industry, and therefore perhaps they don't need to hire talent at higher costs. And that's a statement that's coming from Wipro, which has been picked up by all reports.
How things change, right, Reema? I mean, a year back, we were all talking about this war for talent and so on and so forth. And now that's a massive cut. I wouldn't be happy if I were a fresher in the IT sector, whether I'd applied for Wipro or for any other company, looking at these kind of reductions.
And actually, the report also went on to say that these freshers were promised that join us in August. It got delayed, and now they're saying join us in February, March, but at a lower package. So one, there's been a delay, and two, they are asking them to join at a loss.
That's a great indicator and one worth sort of keeping in mind. Let's see.
But it's not necessarily on demand, right? It's also an indication of the supply side and the fact that attrition is coming down, and therefore you don't have to hire at any price.
Well, let's see how this plays out. IT is definitely in focus. I'm actually looking at slightly more positive things today. So let's talk about what's taking the market higher. Banks. And remember, banks were the problem yesterday. It was really that onslaught, downward onslaught on the Bank Nifty that led the market to a very sort of listless sort of a close. Today, that Bank Nifty position has completely changed. When the market opened till about 10 o'clock, it looked like it's going to be a repeat of yesterday. But then things have picked up, and substantially. The Bank Nifty is up 1% from the opening lows, and right now it's trending close to the highs of the session. Lots of contributors. Pull up the intraday charts of ICICI Bank, SBI, HDFC Bank. They'll mirror that Bank Nifty move that we've seen. So starting negative, but now there's some traction picking up. Question is if it's going to last. The 20 DMA, the daily moving average, that's going to be the next sort of level to look at. That's coming in closer to 41,300 odds. So we are inching towards that mark. Let's see if it sustains or not. But right now, the large cap banks are holding okay. The other sector is really metals. And a lot of the frontline names like JSW, Tata Steel, SAIL, there's a bit of green on these metal stocks as well. Some anticipation of price hikes, which we are seeing in the international markets, perhaps also now taking shape in India. So the metals part of the market is also not too bad. Pavitra, I know you're looking at some metal stocks even beyond the index, right? There's some gainers out there.
Oh, absolutely. The metal stocks are doing very well today. So take a look at even something like, Ratnamani Metals and NMDC Steel, which listed yesterday. All of these are doing quite well. So there's definitely strength seeing across the pack over there. You were mentioning the large cap banks. The PSU Bank Index is one of the largest losers still, right? So some of the smaller names, the bank, like Bank of India, Bank of Baroda, seeing some cuts. You have Canara Bank, which is seeing some cuts. So some of the smaller banks not doing so well. There's been a new directive from the Power Ministry, which is why you're seeing a lot of these power stocks pop. So take a look at, say, Tata Power, you have IEX, Adani Power. All of the other Adani stocks are in the red, but this one is up almost 5%. So do keep that on your radar. Along with the PSU Bank Index, which is in the red, you also have the real estate stocks, which are seeing some cuts. Anyway, this has not, been a very great past couple of weeks for the real estate stocks. But again, cuts coming through in a few of these. I've just put up a few, but, a lot from the sector are under pressure. By the way, we are also getting some visuals which are coming through. I'll come back to the markets in just a bit. And so those are the visuals from the launch of UPI's integration with Singapore's digital payment services provider PayNow. The unified payments interface of India and PayNow of Singapore will now be linked for faster and cost-efficient cross-border payments. So that's important. We also do have the Prime Minister who will perhaps speak on this shortly. But those are the visuals coming through. We'll keep bringing you updates on this as we do get them as well. For now, let's also get a conversation going now. ICICI Securities has come up with a note on mid caps and small caps, and they're saying that mid and small caps have low margin of safety on current profits, but the end of the quantitative tightening cycle and profit trajectory ahead lend support. We are now joined by Vinod Karki, who's the author of this report, and he's the head of strategic research at ICICI Securities, to take some questions. Vinod, thanks a lot for joining us. This is Pavitra. You know, first, just take us through what this is about, how you see the mid and small caps now. There's also talk of more rate hikes. That kind of fear has also intensified going, at least for the March meeting. So take us through where you see mid and small caps now, the kinds of earnings potential that you have versus the valuation.
Yeah, thanks, Pavitra, and good morning to everyone. So if you look at broadly mid-cap and small caps, they are risk assets, riskier assets compared to the large cap Nifty. So you ought to have some spread over the large caps for a rational investor to say that they are reasonably priced. So we look at that discount or premium at times. So in 2018, if you remember, mid and small caps both were trading at premium to large caps. And you saw what happened. There was a massive bear market for mid and small caps through 2018, 19, almost into 20. But after 20, we saw some outperformance, but of late, there's been some fizzling out of that. So if you look at the current picture, the mid-caps, their discount is very marginal. Doesn't give you that comfort of large discounts over large cap, but nevertheless, there's a discount. You have to remember them that in high optimism zone, they're actually traded at premium to large caps. But on the other hand, the small caps and the micro caps we observe, they have expanded some of the spread, so they are at a reasonable discount. Nevertheless, they, if you compare to the discount over the last 10 years, all are lower. So it's a situation where they are neither too cheap or not too expensive to be at the higher, at the extreme end of optimism. While if you look ahead, the mid-cap 100 index or the small-cap 100 index, when I look at the consensus growth, the growth is ahead of Nifty. So Nifty, we are looking at around 15-16%, whereas these two indices are offering 22-23% kind of growth. So, and one thing we have observed is that risk assets, they react to how the quantitative tightening or easing cycle pans out. So last year was the worst case scenario because it was a massive quantitative tightening cycle. But this year, as we have seen, there's a downshifting by the Fed already. And we expect that by the mid of this year or even towards the end of the year, early next year, there could be, in fact, a pivot possible, given if inflation pans out the way we expect. So that will play out for these companies' valuations. So growth being higher than the benchmark large cap indices, and the trigger of valuation from quantitative tightening ending, and that we are seeing. If you look at the holding of FPIs in these indices, what we observed was since 2018 in the small cap index, if you see especially, they held almost 17%, which dipped to 12% by June of 22. And over the last 2 quarters to ending December, there's been an uptick. So it has reached 13%. So I think the relentless selling we have been seeing since the high optimism zone in 2018, that's kind of troughing out, it seems. And if the quantitative tightening cycle ends and growth disappointment is not there, I think they will hold their ground, it seems.
Vinod, the point about valuations, where they currently stack, the earnings expectations, all that is taken. One fear in the market now is that there is a possibility that earnings downgrades will pick up. We already saw that in Q3. Do you see that risk? And where is the maximum risk of earnings downgrade in Q4 and Q1 of next year?
Yeah, so see, that's the key thing. I mean, so if you look at index-wise, we did that analysis for Q3. Overall, it seems a little mixed picture, but if you look at just the Nifty 50, for example, the beats were much more than the misses. But within the same large cap, which the next 50 constitutes, there was a massive, the disappointments or the misses were much more than the beats. And when I look at the mid and small cap index, it was kind of evenly balanced. There were equal number of beats and inline results, and misses were similar, so nothing to take home, basically. But the next 50 was clearly some very high disappointments, while Nifty was actually pretty okay. So it's kind of a mixed picture. We don't know. What we expect is that the demand in the economy, we expect it to come from the investment cycle, be it the capex cycle, the real estate cycle, driving demand overall in the economy. And while consumption, broad-based consumption is looking a little weaker, there are pockets of high growth consumption, although we have to see quarter on quarter how it moves. But the good thing is that commodity inflation is under control, which has hit company margins and led to downgrades earlier. So if demand remains reasonably okay, and if commodity pressure doesn't pick up significantly, I think one should not be too pessimistic about earnings disappointment going ahead. There will be some misses, some beats and all that, but it will be more or less in line. Looks like that right now.
Sure. Got that, Vinod. Vinod, the study that you've done on mid-caps, I'm just wondering if there is any sectoral color to that. I mean, is there a takeaway that kind of tells us that, let's say, valuations or some of these parameters for maybe consumer durable companies or maybe fertilizer companies are more supportive? Just trying to understand if there's any sectoral color or any stock-specific inputs that came out of your research.
Yeah, so what we observed was especially for mid caps, I mean, as I said, overall also there is hardly any margin of safety over large caps, that you say that mid cap is cheaper than the large cap. And we saw that across sectors also. Very few sectors like financials and some of the other similar sectors, banks and all, there was some discount over large caps. But in overall, mid caps are expensive. I mean, if you look at sector, but if you go a little lower in terms of small caps and micro, there is spread. There is some discount over there, but it's not too, I mean, high to really go out and be very aggressive to buy, basically. So the sectors where there is a valuation support are from the investment side of the economy, be some oil, energy companies or some financials. Those are the sectors where there is reasonable margin safety. If you see some of the stocks that we have mentioned where the earnings yield is pretty reasonable, but the rest of the stocks where we do have a positive view, but the valuation comfort is not there much. So the key takeaway is basically that we don't expect the mid and small cap to capitulate that way it did in post 2018. Given what I just said about all the growth and the end of quantity tightening cycle and all. But we don't see a significant kind of outperformance given where the valuations are right now. That seems to be the overall picture on this space.
All right, Vinod, I have the list of stocks that you have, which you've classified on the basis of a deep discount to the Nifty or a premium. Do you want to run us through some of the top ideas that you have, which are perhaps still trading at a deep discount to, the frontline index?
Yeah, so see, I won't go into stocks and all, but what I'm trying to say is that if you look at, the deep discount where the earnings yield is more than the bond yield, if you look at these companies, these are largely from the capital intensive sectors, be it banks, financials, and some of these energy companies, and where the capital intensity is high. And where we continue to like, and we have a buy rating, but we don't have the valuation comfort over there. I mean, they are as expensive as the large caps. The rest, I mean, if you see the bottom, this one, where obviously the asset light kind of companies, the so-called quality companies, they fall in play in that. But so that's the thing. Basically, we have stocks which are from deep discount to premium, but they are there for their own reasons, basically. But these are the buy companies that we have from our mid and small cap coverage that we cover.
Thank you very much, Vinod, for joining in. I need to slip into a very short break. We'll come back and focus on the markets. There has been above normal weather in most parts of India. We'll get you a check on what the IMD is saying with Manisha Gupta on the other side.
Welcome back. It is time to shift focus from equities to commodities. And there's a bit of a scare out there, especially when you're looking at agricultural commodities, thanks to the weather. We know the northern part of the country is in the grip of a severe heat wave. Of course, we've heard reports of some issues with respect to the wheat crop, perhaps if the temperatures don't subside a bit. Manisha's joining in with the latest. Manisha, what do we say? Feeling hot, hot, hot.
Well, absolutely. And that too, even as we are in the month of February.
Yeah.
And we already are talking about heat waves right now. Well, yes, the kind of temperatures that we are dealing with most part of Western India, North and Northeast as well, there is rising temperature there. IMD has said that there is a lack of strong Western disturbance that has led to this early heat wave that you have seen into in the country. IMD also tells us that Delhi, for example, has recorded the third hottest February since 1969, and the Delhi maximum temperatures as of now are 9 to 10 notches above normal. That pretty much is the case in the Western India as well. So when you look at Maharashtra, Rajasthan, Gujarat, you are looking at temperatures 3 to 8 degrees per Celsius higher than the normal temperatures as of now. IMD also says that it is heat wave when you look at 40 degrees Celsius in the northern plains and 37 degrees in the coastal areas, which is Maharashtra as of now. So we are looking at 35 to 37 degrees temperatures in Maharashtra, in some areas in Maharashtra as well. So that does define as heat wave. IMD also has let out an advisory saying that the next 48 hours could be above the normal temperature that you would see in Maharashtra as well. And as you rightly said, this weather has had its impact on the Rabi crops, not so much on the others, but the major concern clearly comes in for wheat. And here as well, we have seen the Agriculture Secretary form a committee to understand the impact of rising weather on the wheat crop as of now. Remember, we already have banned export of wheat. The wheat prices did hit an all-time high in the previous month itself. Right now, because the government is releasing wheat in the open markets, is the reason you have seen the prices in control. But if these weather concerns do continue, then there could be some inflation coming back in case of many of these food commodities.
All right, Manisha, thanks a lot for that. It will be important to see how this really proceeds from here and what it does mean for the agricultural commodities. We do have to get into a short break now, but when we come back, we're going to shift back to the markets. We'll take you through what the technicals are really looking like with Mitesh Thakkar. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. For the market, we're holding at around 17,905, so around 0.4% higher there. Not looking too bad, but it's quite a quiet day like we've been pointing out. We have Mitesh Thakkar joining us for a quick technical check. Mitesh, quiet day, but we're holding comfortably above that 20 DMA level. Which of course was quite a support. How do you look at it here? Because there aren't too many triggers as well, right? At least today.
So I think, this is very typical of consolidation. Yesterday was a negative day. Today we have bounced back and still, not getting any kind of directional bias. I still maintain that it's a contracting market. 18,150 to about 17,700, 750 is the range. And we might not do much for the next few days as we approach the end of February. So the idea is that, you trade with more of stock-specific biases. Right now I have one buy and one sell call. Equitas Bank is something, which has caught my attention on the buy side today. Good breakout yesterday. Today we are seeing good follow through. This could possibly head towards levels of 70, and it's a buy with a stop below 61.5. And on the sell side is SBI Cards. That's given some negative breakdown on the hourly and the 2 hourly charts. So keep a stop at about levels of 760 here. Look for targets of around 730.
Okay, thank you very much for that. Another story that we're tracking today is Minda Corp. Now, at a conference call yesterday, the company said its latest acquisition of 15.7% stake in rival automaker Precol was a pure financial investment. Listen in to some of the highlights that we got from the management from the conference call.
Minda Corporation has purchased 15.7% equity in Precol for a cumulative amount of 400 crores. Through on-market transactions on 17 February 2023. The shares of Precol are purchased solely for the investment of the surplus funds available with the company. Minda Corporation investment in Pricol is through market purchases, constituting a minority stake, and this investment does not grant any special rights. Minda Corporation is and will be generating enough free cash flow from operations to fund our routine capex and organic growth. The company has well-positioned balance sheet. We have, after this investment, we'll have a debt to equity at about 0.3, and the debt to EBITDA will be around 1:1. The long-term debt as of today is about 150 crores. Short-term is to the tune of about 350.
Okay, the other story is the telecom tariff hike, which has taken place at the entry level. So earlier today in the morning, we learned that Bharti Airtel has gone ahead and hiked the minimum recharge plan in 2 circles, Maharashtra and Kerala. So the earlier minimum entry level plan, the cheapest 2G plan, was 99 rupees. Now it's been increased by a massive 56% to 155 rupees. And the company, Bharti Airtel, has been doing this over the last couple of months. India has 22 circles, and with the latest tariff hike at the lower end, the tariffs have gone up in 19 out of the 22 circles. Now, that's the news, right? And we spoke about it in the morning. What we are trying to highlight is the extent of entry-level tariff increases that we've seen in the last three and a half years. So the first big tariff hike took place in November, December of 2019. At that time, the company discontinued that 35 rupee plan and said the cheapest plan is 49 rupee. Then in July of 2021, that 49 rupee plan became 79 rupees. Immediately, 6 months later, that 79 rupee plan became a 99 rupee plan. And as I said, over the course of the last couple of months, the minimum plan is now 155 rupees, which basically means from November, December of 2019, if the cheapest entry-level plan was 35 rupees, it's now increased to 155 rupees. Of course, the company has thrown in a lot more benefits while increasing the tariff there, but 35 to 155 rupees at the entry level is an increase of 340%. At the same time, now if I compare it to the higher priced plans, right? And there are multiple plans that telecom companies offer, but broadly, in December of 2019, tariffs roughly went up by 25%. And then in December of 2021, it went up by 20%, which basically means in the same period, the higher price plans have gone up by 50%. So entry level tariffs are up 340% in 3.5 years, while the higher level tariffs are up 50%. So one would question, right, what explains this kind of disparity? The reason is Reliance Jio is not present in 2G. They started their service with 4G. So here Bharti Airtel doesn't have too much competition. So even if they go ahead and increase the 2G tariff price, it's not that they would lose the subscribers to Reliance Jio. They would lose it to Vodafone Idea, but Vodafone Idea too has been going ahead and increasing the tariffs. So that explains the two differences. Now about this Bharti's recent tariff hike, the hike that we spoke about today, how should you interpret it? Well, it's important. It's a step in the right direction. They're walking the talk on tariff hikes, but it's not very material. According to brokerages, the benefit of upping that entry-level tariff plan from 99 to 155 rupees is less than 2% on the top line. A, because lower-end subscribers don't necessarily top up every month. They may choose to take a break, in 1 month. 2, there is also some churn. Now, remember, in this recent tariff hike, Vodafone Idea has not gone ahead and upped it. So maybe Bharti Airtel loses some 2G subscribers to Vodafone Idea. And also, in terms of the overall revenue contribution, as I said, it's not too much, less than 2%. The bigger impact, the bigger trigger will be when Bharti Airtel takes a 4G tariff hike for either the prepaid customers or even for postpaid customers, which are the more lucrative segment. And between the two, they would contribute close to about 20% to the overall top line. So that's the big sum and substance of what's happened in telecom.
All right, Reema, thanks a lot for filling us in with all of the details there. But another space that we're looking at is all of the power stocks. Remember, the Power Ministry has now asked all imported coal-based plants to generate power at full capacity. They're seeing higher demand and then sell power to the exchanges. So Vivek is here to fill us in with all of the details. Vivek?
Well, absolutely right. So what's actually happened is that, in view of the anticipated peaking demand as far as the summer season is concerned from power. What's actually happened is that the Ministry of Power has gone ahead and invoked Section 11 of the Electricity Act, which basically means that now most of the coal-based power plants are now allowed to import coal from outside of India, and they will be able to do a complete cost pass-through for all of these power plants. Remember, a similar move was taken between May to December 2022, where you had seen a benefit, one-time benefit for both Tata Power as well as Adani Power. IEX2 benefits on the back of higher demand that is anticipated, and also the excess power that is generated by the IPPs will be put up on the exchange for sale. Now, Citi has written a note on this particular development. What is it that they're saying? They're saying that this particular move will benefit imported coal-based plants. They're also saying currently imported coal-based plants are unable to push through the cost-based tariff hikes, and because of that, they're operating at low capacity. So the stock that they are talking about is Tata Power. They are saying that the Mundra UMPP will benefit the most, and this benefit will be for the period that this particular Section 11 sustains. Analysts also say that this particular move is in general positive for coal-based power plants. They're saying that last time around in Q1 of FY23, NTPC's PLF moved from around 70% to almost 80% plus when this particular move came into impact. Merchant power rates will also benefit from this particular development.
Thank you very much, Vivek, for that. Get into a break. On the other side, we'll get you an exclusive chat with the management of JK Tyre. Welcome back. JK Tyre is seeing robust demand for the bus, truck, PV radials. However, in two-wheelers and three-wheelers, the demand is a bit subdued. The company hopes to continue a strong performance in Q4 after seeing good sales in the month of January. Our correspondent, Danish Anand, spoke exclusively with Anuj Katuria, the president of India JK Tyre. He started off by asking about the two new tyre launches and how much market share the company is hoping to capture.
These new two SKUs that we have launched today are part of the Ranger series. As you know that the Ranger series has a lot of good high-selling SKUs. What these two tires will do is it will help us complete the range, complete the offering. We have seen that certain customers are looking for tires which are, can go into any kind of terrain. So the extreme all-terrain tires gives them that option. And there are some very specific features that are made into these SKUs. So I expect that this will be very well accepted by our customers. The second one is the HPE Ranger, again from the Ranger series. So this has been specifically made for the electric vehicles. And this again comes with a lot of features. A couple of them, one is that the noise levels are much lower. And as you know that on EVs, the coefficient of rolling resistance has to be kept at a lower level. So these tires, the HPE, is specifically designed for that, and I'm sure it will be catering to the needs of the EV vehicles, and we expect both of these SKUs to be doing well. In fact, we had launched them last month in Bombay and then again in Chennai. So already these have been, we have started giving these tires to our customers in the market, and they are being well accepted.
So the company had a great Q3 in terms of the total revenue. So as far as your expectations and outlook is concerned, what are your expectations regarding Q4, and where are you planning to finish this current financial year?
Yeah, Q3 was a good quarter for us, and we had quite decent results. So thank you for that. As we all know that quarter 4 is generally the best quarter for the industry, for the auto industry. So we expect that the OE demand also should be good, and followed by equally good demand coming in from the replacement market. So as of now, we have seen the month of January, which was a good month, and we expect that further also the remaining part of the quarter we should be doing well. So very difficult to put a number to it, but I'm sure that quarter 4 would be equally good.
So as far as the demand is concerned, which are those segments in which you're seeing a little bit weakness in demand, and are there any segments within your business which are performing very well beyond your expectations?
Overall, I think so. The demand for the truck and bus radial is quite robust. Passenger cars are also doing well. Yeah, the 2-3-wheeler, especially the 2-wheeler demand is a little subdued. But I think so with the good monsoon that we had and with a good harvest, the rural economy should be doing well. And with that, I see that there would be some revival in the demand coming in from the 2-3-wheelers also. But as of now, I think so the passenger car and the truck and bus radial are doing fine.
So, like you have launched a special tire which is made for EV. So, as far as your future plans are concerned, do you plan to increase production of this special tire for electric vehicles? And 5 years down the line, how much of electric vehicle tire special manufacturing can we expect from the company?
See, these will be purely led by the demand that comes in from the market. So, we are getting our products ready. So, as you see that we have a few products which are already being positioned in the market, and we would be launching a few more, and this is a continuous process. As far as our manufacturing facilities are concerned, we have the flexibility, so we can manufacture from our existing plants these tires as well. So it will purely depend on what is the demand and the penetration of the EV vehicles itself. As we all know that it has started, but it is still a very small percentage. But we expect that in the near future, the demand would pick up, and we'll have to calibrate going forward as per the pull from the market.
So very lastly, you have mentioned the demand, you have mentioned your future plans, but most importantly, what is the update on the raw material front right now? What is your outlook on rubber prices? And as far as margins are concerned, what is your expectation for margins?
Yeah, there's a lot of discussion on the raw material. But yeah, we are seeing a little bit of softening and then stability. So as of now, we don't expect the prices to go up further. But, you know, when the prices were going up and it went up for almost 7 quarters in a row, which was unprecedented for the industry. So that impact of that has not been, we have not been able to pass it on to the market completely. So we are in the process. So on one side, there is a little bit of softening. On the other side, we had been able to pass on some. So we will have to see where the equilibrium gets established. But as of now, the good news is that further increases are not being seen, at least in the immediate future.
And the margins?
Margins, as we said, we reported a Q3 result, which was a high single-digit EBITDA, and it was better than the previous quarters. So we expect that with a little bit of softening on the raw material, margins should improve going forward.
Okay, that's the word from JK Tyre. Let's get back to the market, which is actually holding pretty steady. Not much has changed. It's still banks that are taking things higher. Well, since we are talking about the market, should we be prepared for longer trading hours? Well, at least in the F&O market, if not the cash market. That is the indication that we are picking up from some sources that the NSE is actually holding talk with market participants on the prospects of extending market hours for the futures and options segment. Prashant is joining in with some of the buzz that he's picking up. Prashant, I think this has been doing the rounds. The talks have been on ever since SEBI allowed it. But what are you learning or hearing on this?
Surabhi, I have to say, I started tracking markets sometime in 2000 late 2003 actually. And maybe not immediately as post, but a few years after that, since 2005, one has constantly heard, that maybe this is going to happen. And so it's not a new thing, as you said. It's been on for 15 years plus, right? And every few years it comes up. But I think there is fresh impetus here. And I want to be very careful in terms of how we put this, because this is a sensitive story, not in terms of how it impacts a stock or a sector, but how it impacts the overall market ecosystem. All of us, market participants, investors, traders, everything. So what I am picking up from sources is that the exchanges, and this is being spearheaded by the NSE, is in very preliminary discussions with market participants, brokers, small, large, with respect to the discussions about extending trading hours. That's point number one. The discussions right now are about extending trading hours for equity derivative contracts, which is, index futures, could be, stock futures, etc. as well. But, the wider understanding is perhaps this is going to begin, if this were to happen and no decision has been taken, we are far away from it, perhaps starts with index futures. no deadline or timeline as to by when a decision needs to be taken. I mean, so this is kind of open-ended as of now. The exchanges have sought feedback from brokers in terms of, what they think about it. But there is no cut-off date by which a decision has to be made. Either ways, yes or no, in terms of extending the timeline, the trading hours. There is widespread acknowledgement because I spoke with a wide variety of people in the ecosystem, and there is wide acknowledgement that before any decision is taken, there are various tech settlement and other issues which need to be settled before one can go ahead. And of course, I mean, some of this will have to be done if we decide to go there, which is extending trading hours. So that is another point to be noted. Exchanges are of the view that any changes will happen in a gradual way. Like, for example, what we saw in the case of the T+1 settlement cycle, which, started with a smaller group of stocks. Then, sometime later, another group of stocks was included, and it happened in a phased manner. So any decision will be gradual in that sense. Exchanges are of the view, and I think this is not new, that the current hours are kind of pushing volumes offshore. I mean, SGX, Nifty, of course, etc., have been a constant refrain we've heard from officials. And the other thing, of course, is that it'll be more aligned. This is the argument in favor that longer hours may enable investors to react faster to global events. So you're more aligned to global markets, etc., as well. Now, where does the regulator fall in all of this? As of now, SEBI, there is already an in-principle enabling provision to do this. SEBI in 2018 had issued an enabling provision for the extension to take place. So, as per that, exchanges have the powers to extend the F&O segment trading till 11:55 in the night, and they have the power to extend trade timing in the cash segment till 5 p.m. in the evening. So they don't need fresh approvals. But this is going, I mean, if this were to happen, as I said, no timelines, etc., this would happen. It's pretty big, I'm sure. The regulator has a say in as well. It's a hotly debated topic, and it's been so for so many years, and there are so many arguments on both sides. But I'm just presenting what I'm picking up after speaking, as I said, to a wide variety of stakeholders in the stock market ecosystem. Back to you.
Prashant, I was chatting with one of the market participants, someone from a reasonably large brokerage on this, and we exchanged notes on the possibility, and there was a one-word reply that I got: terrible, for obvious reasons, right? Tough city, Mumbai, and if you have to keep your F&O desks working till 5 p.m., perhaps not too easy. If it's say, for example, Nifty futures, right, and it's screen-based trading, and the point is that online brokers are now a large segment of the market, very large segment of the market. So. And there are no, I mean, I'm sure they have offices, but you don't call into the broker to place an order, right? I mean, you open your laptop and you punch in the order. So I think, they perhaps may be more kind of attuned to and be prepared, in a better way, given the way they operate, as opposed to the smaller brokers. I mean, if you ask associations like ANMI, the BSE Brokers Forum, etc., they largely represent the interests of smaller brokers. And there, I mean, some of the issues that you mentioned, that you need to have staff, stay on, another shift maybe, more infrastructure, etc., the costs go up, and what's the risk reward? Those kind of questions do start to come in. But as I said, I mean, there are so many strongly held positions. It's almost a very polarizing subject, I have to say. But very, very preliminary discussions are on. Feedback is being sought, and as I said, this may go on for a while before we actually get to any sort of decision. Back to you guys.
Nitin Kamath of Zerodha, and he's tweeted on this, and he's saying, I'm conflicted, right? Because on one hand, you do get a level playing field between domestic traders and global, and all the points that you spoke about. But on the flip side, he says, I'm unsure how it will affect the mental health of active retail F&O traders in the long term. Tracking P&L for long hours is stressful, and it can affect life outside of trading. So that's the conflict that Nitin Kamath.
Yeah, absolutely. Actually, we should have those tweets up.
The tweets up
also, active traders don't make money primarily due to overtrading. Longer hours can accentuate that. And this is the largest broker in the country saying. And he goes on to say, while it could boost revenues for capital markets businesses in the short term, I'm unsure if retail investors will end up doing better. This could then potentially lead to lower participation and liquidity in the longer run, which will affect everyone. So, I think Nitin jumped into that debate, and I've been seeing this on social media for the last many days, right? I mean, But this is where things are at. It's not as if something has been decided and something is coming. A lot of what I saw on social media seems to suggest that this is a given, this is happening, be ready for it. But this is just preliminary discussions which are taking place, and a decision could be taken, and there is no end point to by when that decision needs to be taken.
But in our limited history that we've been tracking the markets, we've seen the timings get extended. Yeah, you remember earlier, I think markets used to open at 10 o'clock, and then they made it at 9:15.
9:55, Rima.
9:55, and then they made it 9:15. So even in our history, we've seen market hours get extended.
That's true. But I think I take Prashant's point. I think the way forward will be defined by technology. There's no compulsion to trade all the time sitting on your system, but as you're saying, a lot of it is happening through your mobile phones. And if the exchanges and if the market infrastructure authorities decide to open this up, saying you can still trade on your phone, and if that's the route that is taken, then perhaps it's going to be a completely new era, at least when it comes to derivatives trading in the country. All right, Prashant, thank you very much for that all-important story. We will take a quick break on that note. On the other side, we will tell you which stock is on our radar today from our list of top 20 stocks to watch out for this year. Stay tuned.